Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. At the time of this video, Tesla has a forward PE ratio of 82. And of course, with the stock down where it is, this is much lower than usual. If the stock was where it should be and the world wasn't currently in this tragic state, then it would be closer to a forward PE ratio of 120. But even 120, does that sound low to you? Let's first take a step back. We all know that PE is price-earnings ratio, and it's the number of years of earnings it would take to reach the current market valuation of a company. The most commonly used is the trailing 12-month PE ratio, which is a total of the last 4 quarters' earnings relative to the current market value. Personally, I don't like the trailing 12-month PE ratio, at least not for Tesla, as it's such a growth company still, especially when these exponentials are going to start kicking in exponentially. As you might have noticed, I like referring more to the current quarter's earnings and generating a PE ratio based on that annualized. To give you an idea of how inaccurate a trailing 12-month PE ratio might be, well, Q1 2021 had an EPS of 39 cents. Q4 had an EPS of $2.05. The same year, yet 5 times increase in profit from start to end. Hence, why the trailing 12-month isn't very accurate for Tesla. Well, it's pretty much redundant in terms of valuing Tesla. I would say that alone would be an important lesson to any Tesla investor. Just how Elon is playing 4D chess, Tesla is a 4D stock. You can't value it with your legacy methods. Forward PE is much more suitable for a growth company, as it's based on a price over the next 12 months, rather than the previous 12 months. Therefore, you might think a forward PE of 82 is a good way to look at Tesla's valuation. This compares to a trailing 12-month PE of 165. That is over twice the difference. Quite the discrepancy. For comparison, Apple has a trailing PE and a forward PE of both 27. Due to such a difference in PE ratios, this is why I see little value in what Tesla did in the last 12 months. What lays ahead of Tesla is much more important. Except for one thing, who came up with Tesla's 12-month forecast for the forward PE ratio? It wasn't Tesla, nor likely someone who understands the company like we do. We can't rely on Wall Street forecasts as they are simply wrong every single time, and we always beat them on our estimates, no exceptions whatsoever. So I'm just going to do some quick math at the start to try and just give you some accurate representation of this forward PE ratio of 82. And like I said, I like to work out a PE ratio based on the current quarter's earnings. Q4 2021 generated $2.3 billion in earnings, which annualized comes to $9.2 billion. The current market cap for Tesla is $831 billion. Now, when I divide $9.2 billion into $831 billion, it comes to 90. Therefore, the quarterly PE ratio related to Q4 is 90. Yet we are given a forward PE of 82. In other words, for the whole of this year, Wall Street expect to increase from a PE of 90 to 82, a 9% increase in profit over 2022 compared to where we were at Q4 2021. This is how the forward PE has been valued. You can see all the numbers here right for yourself. This is exactly right. The numbers don't lie. That's why I try to base so much analysis off actual numbers and try and explain as best as to how I arrive at these numbers. Okay, I hope that's clear to everyone, and this has nothing to do with macro issues. This is just how bad Wall Street is at accurate forecasts. So the point I'm trying to make isn't that the stock is particularly low or anything, although I'm pretty sure it is. My point is just how inaccurate this forward PE surely is. Tesla would need to do an overall 9% improvement for this year compared to where they were last quarter to achieve a trailing 12-month PE ratio of 82 for the end of 2022. It would probably end up meaning that perhaps Q4 2022 profits were going to be about 20% higher than the Q4 2021 profits. Not that a 20% improvement in profits isn't good for most companies year over year. I just don't think it's Tesla good. Yet this is the forward PE ratio we are given, but we have done economies of scale models. We know that in order for Tesla to increase their profit by 20%, then it would likely only take an increase in production of 10%. Okay, Wall Street's forward PE has priced in Q4 2022 to have 10% more deliveries than the equivalent of Q4 2021, a year ago, when Tesla didn't have their 2 new largest factories running. Okay, I just wanted to say something about these factories. They will actually reduce profit margins somewhat into the year, and actually profits may be down as well. But Wall Street is not factoring that in. However, we will and try to get as best accuracy as possible. I actually think a forward PE ratio would be a great way to value Tesla, but we need to get the future 12 months right first, because I have a feeling that Tesla may beat Q4 deliveries by over 10% this quarter already, let alone Q4, immediately showing that Wall Street is totally wrong. How about we find out what the real forward PE ratio will be then? I'm going to try and estimate the profit that Tesla can generate for the entire year of 2022 and relate it back to the forward PE to see if we can't figure out a real PE ratio to value Tesla. I recently created a video on my 2022 Tesla price target, which I would recommend watching first. It is quite related and showed my Q4 2022 estimates along with my entire deliveries estimate for the year broken up into factories, models and quarters. We'll be basing this video on those, so watch the video if you'd like to know more about how I arrived at these delivery numbers. I'm going to use the estimates we calculated in that video to see just how much profit Tesla will generate through each quarter so we can get a true idea of Tesla's actual earnings and evaluate our own forward PE ratio. I've gone through each quarter individually and compiled my estimated earnings for each of them. If you want to know in detail, I do offer the spreadsheet downloads in some of my Patreon memberships, but it was a lot of work and would have made this video too long. Now, I can't be entirely sure about just how much the cost of these new factories are going to be to run initially relative to production. How low will they take margins? This is a bit of an unknown, and I obviously looked at the impact we saw on margins when Shanghai was ramping. But to be on the cautious side, for Q2, I've taken margin all the way down to 22%. This is because these new two factories are the biggest and thus will carry the largest overheads. Don't forget, Shanghai and Fremont should still be ramping through this time as well, so I'm sure this will most likely be on the conservative side. For Q3, I've increased the margin back up a bit to 25%. Then we have Q4 at 32%. By this stage, the new factories would have hit volume production and we'd be reaping more margin savings from advances like 4680 batteries and front die-cast molds, along with chip shortages hopefully being a thing of the past. But I'll beat you to it in the comments. Yes, I wouldn't be surprised if margin's actually up to 35% then. Of course, this does all feel highly theoretical right now with what is happening in the world until we have a more global stability. So yes, I'm aware the price of everything is up in the air right now. I've made some estimates for energy too. I gave energy a bit of a boost as we should expect something coming from the new Megapack factory in California. This brings us to a total gross profit for each quarter of $5.7 billion for Q1, $4.9 billion for Q2, $6.3 billion for Q3, and over $9.2 billion for Q4. I've included some OPEX for each too, which brings us to our operating margins as high as 20% for Q1 and Q4, but down to only 12% in Q2. This then gives us our earnings for each quarter at $3.7 billion in Q1, down to $2.7 billion in Q2, then nearly recovered back in Q3 at $3.6 billion, and then a massive $5.5 billion for Q4. Q3 seems to have recovered to about where Q1 was, but then hopefully the new factories have ramped up more by the end of this quarter, along with the 4680 battery production. Then when we get to Q4, it all starts to get exciting. This is the turning point. And as I've been saying, 2023 is looking good. As we can see here, that if margin does drop that much in Q2, even despite all the additional units produced, we have a drop in EPS. The margin may be higher, but even if it was 25%, it would still only be $2.90 EPS, which is still lower than Q1 at $3.24. I have spoken about this before, so be prepared for it. It could be a good buying opportunity. Of course, you can't predict the future, and like I said, we never know about the Black Swan events. And now we're pretty much seeing the two largest Black Swan events in my lifetime back to back. This brings us to the total EPS for 2022 of $13.62, up from $4.90 in 2021. That is an 180% increase in earnings year over year, yet only a 70% increase in deliveries, even despite such low operating margins in Q2. Alright, now that was all fun, but let's not forget the purpose of this exercise. If we total all the earnings for all the years, we come in at $15.5 billion. Let's feed that back into the current stock price, which at the time of this video is just $804 and a market cap of $831 billion. That is enough data for what we need. Therefore, we divide the market cap or company value by the earnings number we calculated, which results in a value of 54 years at 2022 profit, also known as a forward PE ratio of 54. Let's look back again at what Wall Street had for forward PE ratio, and it was 82. That is a massive discrepancy again, and it's unlikely they factored in the reduced margins from the new factories. Of course, the Street's delivery estimates will be off by just as much as well. So bear in mind, this does include 2 quarters with no growth, in fact one of them with some reasonable decline. And if you were wondering, and we take 2022 Q4's earnings and we annualize that, that would be a PE ratio of around 37 at the end of the year, implying that if Tesla stock held where it was today, by Q4, Tesla's earnings annualized will be 1/37th of the value of the company, at least according to my estimates. I think forward PE ratio is one of the better metrics to judge Tesla's value on, but you have to use an accurate earnings figure, obviously. Anyway, one more way to value Tesla, and it still looks good to me. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.